This is the current federal tax developments for the week of March the 9th, 2026. Current federal tax developments are brought to you by your state society of CPAs. Our goal today in the session is going to be to look at some of the most recent and significantly impacting us court decisions, revenue procedures, and IRS guidance. We can help our clients hopefully work through all of this stuff. And we'll keep up on what's going on here during the main part of tax season, because I know, like most of you, I'm pretty busy right now. So we're going to talk about what's going on. So let's give us our overview here. We have quite a few different things that happened this week. First, we're going to have a very harsh warning for fiduciaries in a district court case regarding unpaid estate taxes and personal liability for those taxes on the part of that party. Next, we'll review a tax court case that serves as a critical reminder of how retroactive check-the-box entity classification election can completely wipe out a partnership's basis, as it did in this case. We'll briefly cover the new 2026 passenger auto depreciation limits and lease inclusions amount. That's mainly so you know they're now out there, if you weren't aware they'd come out this week. Next, we'll have two different cases dealing with the intersection of seriously delinquent tax liabilities, right, and passport revocations under IRC Section 7345. And both of them show the very narrow jurisdictional limits courts have in these matters to essentially address a client or a taxpayer's complaints. We're also going to look at emergency waivers that were just issued for the foreign and income exclusion, time requirements for expats that were forced to evacuate certain countries, and what dates are key in that list. And finally, we're going to discuss the IRS new proposed regulations that will eliminate the paper filing default for digital asset reporting on Form 1099-DA and their request to consider, should we allow basically all brokers, no matter what assets they're dealing with, right? So when we're talking about they're dealing with standard securities, could we allow them to simply say either allow us to give you a digital 1099, right? Miscellaneous 1099, I should say, interest, dividends, and B, or we're going to get rid of you as a customer. So we'll talk a little bit about that too, as how all of this could go. But with this, let's go ahead and get ourselves started with a Kansas District Court case. This is United States versus Monte Karst, case number 5:24 CV04090. And this one came from the U.S. District Court for the District of Kansas, as we mentioned. And the decision came down on February the 27th. For anyone who advises executors, trustees, or estate beneficiaries, this state is a cautionary tale about how you can get liable by being associated there. It perfectly illustrates what happens when the estate fiduciaries prioritize distributions to themselves over satisfying obligations to the IRS. Yeah, that's not a good thing to do. We'll just phrase it like that. So, in this case, the core issue here is the government's effort to reduce an estate's unpaid tax liability to judgment, and more to the point, to hold the fiduciaries and beneficiaries personally liable for the debt. Now, why it matters is because the IRS doesn't just write off estate tax debt when money has disappeared from the estate's account. Well, the estate owes its tax. There's no money left there. Tough luck. This case highlights the strict liability mechanisms the government can and will utilize when estate assets are distributed prior to satisfying tax debts. Not a good thing to do. And this is something people get in trouble with to a certain extent because the IRS doesn't necessarily move terribly fast in going after this case. And the problem is, the taxpayers in this case, or the beneficiaries and fiduciaries, because they're the same people, essentially, I think, took the fact the IRS didn't rush in and grab things right away as meaning they'd gotten away with it. Well, it didn't quite work. The court ultimately granted summary judgment entirely in favor of the government, and we'll look exactly how the taxpayers managed to get themselves into this mess. What did they do to cause the problem? So let's talk about setting up the case. The decedent, Donald Karst, passed away in 2007. He left behind a gross estate valued at nearly $3.98 million, just under $4 million, which included several oil and gas businesses held in a revocable trust. Standard type of estate structure these days. His two sons served as co-trustees and were the primary beneficiary, with one son also acting as the estate's executor, right? Because you often have, in a case like this, you might have a revocable trust, but you also have a probate estate set up in certain cases for various reasons. Now, the Section 6166 election comes into play in this case. The estate self-reported tax liability of just over $792,000 and properly elected under 6166 to defer and pay the tax installments over time. As you probably are aware, this is a very standard and useful liquidity planning tool for estates or holding closely held businesses that you can't just convert to cash without, instantly. Now, the crucial misstep that came up and caused the problem was that the brothers began simply stopping making their installment payments after June of 2015. They were 8 years in. They just decided they were going to stop paying. And having done that, what happened in the interim was, with the passing of interest and the like, the debt ballooned to $1.1 million because of accumulated interest and penalties during that time from 2017 until we get to essentially 2025 as the IRS goes to court. So what happened was the brothers proceeded to distribute the estate's assets to themselves. And that's the bad sequence of events, because it set them up perfectly for personal liability trap we're going to take a look at here when we look at this case. So the government's strategy was simply to pursue more summary judgment to reduce the estate's liability to a money judgment, first step, and then hold the two brothers personally liable. Once they get a judgment, we're now, that gets us outside the 10-year statute, right? They have a judgment to enforce. Now, the brothers tried to rely on the standard 10-year collection statute limitations. And they're saying, Dad died in 2007, right? Estate tax return was filed shortly thereafter. And hey, today it's 2025. The 10-year statute's long gone. You were just too late. However, 6166 has a trap for the unwary. If you're experienced, you know what this trap is. Electing the 6166 deferral isn't just about cash flow. It legally suspends the 10-year limitation periods on collection actions by the IRS. Because the IRS didn't officially terminate this election until May of 2018, that collection deadline was May of 2028, well after the 2025 date the IRS filed suit. So the government's 2024 date. The government filed lawsuit in September of 2024, and that's, as I said, well within the time frame, right? Over 3 years before this thing was going to go under, right? We're going to have where they couldn't do the claim. So government has properly filed the lawsuit, which is now a bit of a problem for the brothers, right? Because we get to what's called transferee liability, which transferee liability means somebody's going to end up being personally liable, or many people are going to be joint and severally liable. Now, this comes under Internal Revenue Code section 6324A2. That is a powerful tool to the IRS. It imposes personal liability directly on trustees and beneficiaries who receive estate property when taxes are left unpaid, either the estate taxes of the estate, right, or taxes of the individual, right? Now, the personal liability is capped at the value of the estate property that the individuals received. So you're not liable for more than you got. But you got to make sure when you get property from an estate that there are no outstanding tax liabilities. While the executor has primary liability, the IRS can, if they can't get it from the executor, they can go after the beneficiaries for this too, right? In this case, the math heavily favored the IRS. The brothers had distributed approximately $3.97 million in estate property to themselves, because this was way over the $1.1 million tax liability The court had no issue holding them jointly and severally liable for the full amount of the debt. Each of them had received enough by themselves to pay the $1.1 million balance due. Remember, jointly and several means the IRS can collect that entire $1.1 million judgment from either brother. If they find assets to seize that are easier to grab from one than the other, they can just take from that one. That's what joint and several means. Now, again, had some, let's say there'd been more heirs, or had the heirs received less, so that neither one got 1.1 million, then yeah, each one would have been capped at whatever they got. But they don't have to take half from each. The IRS can just, take the money where they find it up to the amount that the heir got in this case. Okay. Now, there are a lot of failed defenses here they tried. They did try a Hail Mary, arguing the IRS did not properly break down the interest and penalties. Right. The court quickly dismissed this whole theory due to severe litigation missteps by the parties. Right. They weren't going to go with that. The brothers had already stipulated to the tax deficiency amounts in the pretrial order. In federal court, that's legally binding, precluding them from suddenly contesting the math later. That's a big issue. They also, preserved 3 affirmative defenses in their filing, but completely failed to raise them in their summary judgment response. So the court said, you abandon that. Therefore, the final tab, the court granted summary judgment for $1,105,111.34. Can't forget the pennies, plus statutory additions and interest that will continue to accrue. Expensive error here in this case. So we have our infographics. Been adding these recently. We have them if you're watching the video, right? This is a summary to basically you could share with clients. If you go get our slides from the website, that's a PDF page by itself in full color. If you have a color printer, you want to produce it for the clients. If a client acts as an executor, this is a case not just of what the IRS can do, but what they did. Please remind people, these cases we're talking about tax cases. Yeah, they caught them. People got on the hook for this amount of money. This is not a case where, the IRS would never really do that. If I'm talking about it and it's a case, they did it. In this case, they did, right? It had a self-reported $792,000 tax liability spiraled into a $1.1 million personal judgment that is joint and severally collectible, right? You can see basically the timeline. The brothers stopped making payments in 2015, but the installment plan kept the statute of limitations alive, right? In essence, the statute had been told. It hadn't run at all by the time they started paying. By the time they stopped paying, there was no running of the 10-year statute. Only when the IRS finally terminated that installment agreement did 10 years start to go. If you look at the right side of the image, it's the core issue, taking massive premature distributions. And by the way, you don't just get in trouble with taxes by doing this out of an estate. There's a whole lot of reasons why attorneys will greatly counsel you against clear up everything. Make sure you've taken care of everything, and we've gotten clearances. Whatever you have to publish, get it published and wait the waiting times to make sure there's no liabilities that they could argue you hadn't done a decent job of looking for or you should have known about. When my father passed away 2 years ago, that was what the attorney basically told us. Key issue is the estate was very liquid at that point. No real problem there. Everything had been already moved into securities, etc., prior to my father's passing. But, you want to make sure that there's not liabilities out there because, hey, the fact it's this liquid also means, a creditor's going to have an easy time collecting it. If they come back and they can somehow come through, or if the IRS could come through, one of those things. So, yeah, go down that path. Don't just take money from the estate. They took distributions of the oil and gas leases and other items. While this tax debt still existed, triggered the joint several liabilities. Don't take the distributions until we've settled the tax. Now, I realize they just wanted to do it. I'm sure there were issues like there wasn't cash flow. They couldn't figure out how to get the cash. But the problem is taking that asset and giving it to the individual, in this case, the 2 brothers, that just moved liability straight onto them. Which means, by the way, the IRS doesn't just have to take the leases. They could go after, this is a $1.1 million judgment, which they could go try to satisfy with any property the brothers have. So it's kind of bad. So this is under 6324A is where you find these issues. Okay, the next topic coming up now, we look at the case of Continental Grand Limited Partnership versus Commissioner, 166 TC number 3, a published tax court decision issued on March 2nd, 2026. Now, the core issue here is this case deals with the intersection of Subchapter K of the Internal Revenue Code, the partnership areas, and the check-the-box regulations. And what it's going to look at here is how the taxpayers got themselves into a bit of a problem, eventually, with a retroactive entity classification election that impacted the basis of a self-issued promissory note that one of the partners contributed to the partnership. And why this matters is this is a very unforgiving warning about the absolute finality and federal law consequences of making retroactive structural choices. You're bound. Check the box is a bunch of let's pretends. But once you've decided to pretend, you're bound with that pretend. And this is where things went wrong in this case, right? Pretty straightforward. So this is a very technical decision that we're looking at here. And it was decided earlier this month. Right, we're looking at this issue. And again, this case explores the interaction of Subchapter K, the partnership rules, and the check-the-box entity classifications. Right? And again, it blew away all bases in a self-issued promissory note that was contributed to a partnership. And why this matters to you is if you're advising on entity structuring, this case is an unforgiving warning about how check-the-box may be a fiction, but once you've checked the box, that fiction is going to be applied as if it's reality for tax purposes, right? It is absolutely final when you have retroactive structural choices and the severe federal tax consequences of overlooking the deemed mechanics of this retroactive change. Yes, the LLC stays around. Okay, that's fine. It will stay around. There's no question. Or whatever the entity type was that is qualified for check the box. Legally, it didn't change, but we pretend that we went through some alternative transaction that changed it. And that means we have to go down this path. So let's talk about the transaction here, right? The taxpayer was a foreign affiliate of Computer Sciences Corp. It engaged a multi-step transaction. On March 26 of 2021, CSC Germany issued a massive promissory note valued over $610 million to its wholly owned subsidiary, CSC Financial. That very same day, CFC Financial assigned this note to a newly formed Nevada entity, call it Continental Grand Limited Partnership, in exchange for a limited partnership interest. More than a year later, in April 2002, CSC Financial filed a check-the-box election for this entity to be treated as a disregard entity. What they did was, they used the ability to do this and the rules to make this election retroactively effective to March 23rd, 2001, 3 days before this note was contributed. So it hadn't been issued or contributed. So now we go back retroactively, make this treat every asset owned by the entity as owned by, in essence, CFC Financial, right? And that's where you get in trouble, right? The entity is there, right? Okay, let's talk about some of the mechanics here. We have a deemed liquidation. So we take a look at the regulations. In this case, the judge methodically walks through, in the opinion, the mechanics of Treasury Regulation 301-7701-3 G1 When entity elects to be disregarded, it triggers a deemed liquidation, distributing all assets and liabilities to the single owner. And because the election was backdated to March 23rd, 3 days before the note was issued, CFC Financial was deemed to have liquidated on that date, right? Therefore, when CSC Germany issued the note on March 26, CFC Financial legally did not exist as a separate entity for federal tax purposes. And the tax court ruled that the issuance of the note must be entirely disregarded. Right? Instead, the transaction was treated as CSC Germany contributing its own self-issued note directly to the partnership in exchange for a partnership interest. So it's an IOU, the partnership for its interest. That's not going to be a good result under subchapter K, right? Your subscription note is problematical under the partnership, under basically historical partnership law has always said there's no basis there, right? When you do that until you make payments. Right? So here's how we connect the dots. Once the courts established that CSC Germany contributed its own notes, it turned to the basis rules. Under sections 722 and 723, both the partner's basis in the partnership and the partnership's basis in contributed property are equal to the contributor's basis. Okay. To find the adjusted basis, we then look to IRC section 1012, which defines basis as the cost of the property. And applying the regulation definition of cost, we have a zero basis trap. The court noted that the note in the hands of its maker has no cost. If I sign an IOU, right, I don't have basis in an IOU, right? That's just someday I'll pay you. That's not anything I have basis in, right? So because CSC Germany paid absolutely no money or property to create its own note, there is no basis. As a result, its adjusted basis was zero. Therefore, its partnership interest basis now in this new thing after they went through the whole check the box and then had other partners come in. When all that's done, its partnership interest basis and its basis in the note are both zero. That's going to be a problem because they're going to want to use that basis, right? Now, the taxpayers desperately tried to argue that this interpretation destroyed their state-created property rights. Right? Let's say this is in the state of Arizona. The state of Arizona says this is an LLC, and that LLC has a right, to enforce payment, basically against this company. It was contributed, right? So, essentially that's a state-created right, and you have, you don't do property, right? So you're just federal tax law. But the court rejected that. It notes that federal revenue acts designate how state-created rights are taxed. And this goes back to the taxpayers tried to argue an argument based on the Tufts case, right? Arguing the obligation to pay creates basis. But the court easily distinguished the note in the Tufts case, pointing out that in Tufts, the loan was a cost requiring property. So in essence, if I went out there, right, and I acquired property with a note, then there is some basis in that note. Right? Whereas here, the obligation was not a cost of making the note. They just made it. Now, corporate precedent was also dismissed. Again, the taxpayers tried to cite corporate basis cases like Lessinger and Parachi, but now we're going to go back to essentially, where this case should be appealed. Now, the court noted that the cases mentioned there, Lessinger and Parachi, applied to IRC 357C transfers to corporations, not to subchapter K. It was a corporate transfer, not a partnership transfer. And in fact, the Ninth Circuit in Parachi explicitly warned its holdings didn't extend to partnerships, right? The partnership be different. Ultimately, the court was unsympathetic to the taxpayers' unforeseen consequences. In essence, I didn't realize when we did this, we destroyed the basis, right? The court said you can't use hindsight to roll back a retroactive structural choice just because the tax outcome is unfavorable, right? You made the choice. Whatever the consequences are of the choice you made, you are stuck with them, right? And when you retroactively recast the transaction, which you are allowed to do, but once you did it, you're stuck with that retroactive recast. In essence, we got to follow the fiction. So let's talk a little bit about this particular case, right? We got our infographic again, right? So infographic shows us a zero basis gap trap. if you're looking at this online on the video, where you've downloaded the slides, the center graphic pretty much illustrates a zero basis trap because disregarded entity is treated as a branch or division, triggering its own self-issued promissory note. The partnership results in a $0 basis, right? And also take a look at the bottom right chart on this screen. Right? It highlights exactly on entity classification status, flips the federal tax treatment of this transaction. What would have been recognized as valid debt under the regarded status is entirely ignored and treated as an internal division activity once the retroactive check the box election took effect. In essence, the perfect example of snatching defeat out of the jaws of victory is what ends up happening with regard to that basis. Okay, now along just a standard revenue procedure, something a little calmer, right? This is passenger auto depreciation limits for 2026, right? And this is Revenue Procedure 2026-15. So it was issued on March the 3rd, and this is just simply the annual update dictating automobile depreciation limitations and lease inclusions amounts for 2026 calendar year. So again, the core issue we look at here, every year we have to look at these tables to advise clients properly on the acquisition or leasing of business vehicles. And if you're preparing a return, you're going to be looking at this. You're going to be setting up tax depreciation schedules for 26, which you're going to need to do any tax work for 26, and is also really helpful if you're even a non-tax person who's doing A&A work. We need to know our timing differences, and this is going to be where our timing differences go, right? We'd have that in there. So this is the exact dollar limits and tables necessary to take deductions under 280F for what we normally refer to as the luxury auto rules, right, in this case. And for newer staff, remind the purpose of these limitations. The statutory term passenger automobiles also includes trucks and vans. Now, all of us should know that, but brand new people who are just coming into tax may not realize that passenger automobiles for this purpose does include trucks and vans. Trucks and vans will come under this rule. Okay. Now, as you probably are aware, right, Section 280FA intentionally caps those early year depreciation deductions to prevent accelerated write-offs on what were deemed luxury business vehicles. Now, 2026 is going to be an inflation bump because Congress requires these limits to be indexed annually using the automotive component of the Chain Consumer Price Index, which is, I love these abbreviations, the C-CPI-U, right? For 2026, we saw a substantial upward inflation adjustment of 23.468% applied to the base limits, which was then rounded to the nearest $100. Yeah, cars got more expensive. Might have noticed that, right? So this significant adjustment is going to directly impact our tax planning conversations with clients who acquire, business vehicles during this year, and why it might be advantageous to kind of, make sure you get something that's exempt from these rules in your mix. The real complexity is the interaction of vehicle depreciation with the bonus depreciation limits, right? You may remember that we have to factor in the recent passage of the One Big Beautiful Bill Act. This legislation amended Section 168K to restore 100% bonus depreciation for property acquired and placed in service after January 19, 2025. Now, pre-OBRA property phases down eventually to a 20% deduction for bonus, then to zero, right? The $8,000, it would have been 20 this year, right? So regardless of whether the 100% or 20% bonus applies, and it's unlikely 20% applies because that would apply if you acquired the vehicle back before basically the Tax Cuts and Jobs Act, but you didn't place it in service until this year. Then we get into different rules, right? Or if we acquired it before January 19th. I guess actually the pre-17 acquisitions, that would simply get back to the really old rules. So we kind of got that in play. So what you want to do is you want to read the tables that are included with this particular revenue procedure, right? Table 1 includes an $8,000 bump, setting the first-year limit at $20,300. If bonus depreciation does not apply to your vehicle, right, you must use Table 2, which limits that first-year deduction just $12,300. So you're going to get up to $20,300 this year, right, of bonus depreciation, assuming you qualify. You qualify for bonus, that'll be your depreciation limit. Now, remember, under 168K, we do compute bonus depreciation, right, and we just limit the car to this. Now, we also need to be very, very vigilant about the exceptions. If a vehicle falls into any of these categories, you're strictly bound by the lower limits in Table 2 and no bonus. Most commonly, bonus depreciation is disallowed because we discover the client failed to use the passenger automobile for more than 50% for business during the tax year in question, 2026 in this case, right? And that could become retroactive if they fail to use it in a future year. We get swapped back in that case. So you got to worry about that, right? You also default to Table 2 if the taxpayer affirmatively elects out of bonus depreciation for the asset class, or if they acquire a used vehicle that fails the specific, now much tougher to violate related party or prior use acquisition requirements under 168K2E. Used to be you couldn't get bonus on used property. Generally, these days you can unless you owned it before, right? Or you acquire it from certain related parties, right? And ensure that your staff is checking the placed in service dates and business use percentages for automatically applying the Table 1 bonus bump, right? Because that is also a problem. Again, I don't think I have many vehicles we acquired prior to September 28th, 2017 that would not qualify because they did that. They were acquired back then, but not placed in service till now. Yeah, that would limit you as well, but we're not going to worry about that, okay? Now, also, this is the updated lessee income inclusions. Now, just want to remind you what this rule is meant to do. This is found in 280 FC2, and it was meant to give tax parity between taxpayers who purchase a luxury vehicle and those who lease them. And it prevents leasing from becoming a backdoor workaround to depreciation caps. That was the purpose of this. So, to achieve this parity, lessees are required to reduce their allowable lease deduction by calculating the lease inclusion amount, which is what comes from these tables. And you use Table 3 of this particular revenue procedure to do that. That table dictates the specific dollar amounts that must be added to gross income based on the vehicle's fair market value. So for any clients who have leases commencing in 2026, you need to go apply Table 3 formula, noting that these inclusion amounts will generally increase each year of the lease term. That's how this runs. So again, we have our nice little infographic here, right? You can share this with staff, you can share this with your clients about what it is. Okay, it clearly juxtaposes the $20,300 limit for vehicles qualifying for bonus versus the $12,300 limit. What qualifies for each category, right? Right? And also takes note of the $62,000 threshold on the right side of this item. For leases beginning in 2026, a fair market value exceeding $62,000 is a trigger point we must begin calculating and applying the income inclusion adjustments from Table 3. That's a fair market value. And realize that just, today, we are looking at average vehicle costs that are not very far below, for new vehicles, that $62,000 lease inclusion number. And in many cases, the vehicles that your clients are buying, are, especially for the owners, which is where we tend to get a big problem here, are going to be above that $62,000 value of the car that's being provided. Okay, now we're going to move away from depreciation and into tax controversy and collection. And this is serious. This is the consequences of unpaid tax debts and losing your passport under Section 7345. And our first case here for passport certification and a taxpayer arguing they were victimized, which they were, This is the case of Shaban versus the Commissioner of Internal Revenue, Tax Court Memorandum Decision 2026-24, and a decision was issued on March 3rd. Now, this case involves a medical doctor who co-owned a family business and fell victim to a massive $9 million embezzlement scheme orchestrated by his own brother. Okay. The brother failed to pay trust fund taxes, right? Which means generally the payroll taxes withheld from employees' wages. So FICA, Medicare, and federal income taxes, right? That resulted in trust fund recovery penalties being assessed against Dr. Shaban as a responsible person. Now, we're not going to really discuss much here about whether he should have been. That's a different problem. And unfortunately, this isn't the point of the proceeding. You can raise that issue, as we'll discover. Because that amount exceeded $147,000, right? Yeah, well exceeded that, and remained unpaid, the IRS certified it as a seriously delinquent tax debt, which meant Dr. Shaban's passport was now in real danger. Now, the core issue here is the taxpayer attempting to challenge a 7345 passport certification to the State Department by arguing they shouldn't owe the underlying debt because we're a victim of third-party fraud. Now, why this matters at the end of the day is highly significant because it perfectly illustrates the ruthlessly, no other way to look at it, narrow justification of the tax court, or jurisdiction, I should say, of the tax court in a passport certification case. They don't have powers to deal with every issue you may think of, right? And as we'll talk about here, the court is strictly limited to determining whether the procedural certification of the debt was erroneous. The court cannot and will not use a passport proceeding to review the merits of the tax assessment, even in a highly sympathetic situation, which the court found this to be, involving embezzlement by your own brother. That's a sad situation, but this isn't the proper venue to get relief. So let's talk about the basic setup of this case. The taxpayer, Dr. Shaban, co-owned family businesses and unfortunately hired his brother to manage payroll and tax filings. Yeah, that didn't turn out too well. Unbeknownst to the doctor, the brother embezzled approximately $9 million, which included unpaid trust fund taxes. Yeah, it's not good. The IRS determined Dr. Shaban was a responsible person under 6672 and assessed trust fund recovery penalties against him. Now remember, you can be a responsible person if you knew or should have known that trust fund taxes weren't being paid, and if you were aware in the past they had been, and you didn't take sufficient steps to follow things up and make sure they had been paid, going forward. In essence, playing ostrich at that point is not a valid reason. The question quickly becomes, under that issue, if you're really looking at the merits, it would be, did Dr. Shaban have a reason to know, or was he just recklessly not concerned about whether the trust fund taxes have been paid? But that's not really our discussion today, like it or not. Certainly the doctor doesn't like the fact that's not our discussion. So to collect, the IRS issued lien and levy notices. And really important here, because this was where he could have raised something, potentially, he failed to request a collection due process hearing. And after an offer in compromise was rejected and the collection due process rights lapsed because he didn't request a hearing, an IRS official certified his $147,274 debt to the State Department as a seriously delinquent tax debt, and that meant his passport was in serious jeopardy. Dr. Shaban will not be able to leave the country until he gets that thing taken care of in some way, shape, or form. So, not a good thing. Right? Now, Dr. Shaban filed a petition with the tax court to reverse certification, and he threw 4 arguments at the wall for the tax court to consider. First, he said he argued he shouldn't be liable for the trust fund recovery penalties because he was a clear victim of his brother's undisputed embezzlement. Secondly, he argued identity theft. He claimed the IRS should have applied discretionary administrative exceptions for victims of identity theft. He argued that was part of this. Finally argued the certification was premature because he planned to exhaust his refund, litigation rights. And he claimed the IRS violated delegation rules because the computer system generated the certification list. As we'll discover, none of these are going to be helpful. This is a strictly procedural issue, right? Jurisdiction under 7345E1 is incredibly narrow for the tax court. Tax court is only there to determine if the certification itself was erroneous, not whether the assessment was erroneous. Right? There is no review of the merits of the assessment. The court stated it had absolutely no jurisdiction to review the underlying tax liability during a passport proceeding. The statute simply requires that the tax has been assessed, does not require it was properly assessed. Of course, what the doctor's trying to argue is he's arguing that it wasn't properly assessed, not that it wasn't assessed, and it has been assessed. That means there can't be collateral attacks on the liability. This passport revocation hearing doesn't allow them to launch an 11th hour attack on the tax, basically the trust fund recovery penalty liability. It's too late. You missed your chance. And the criteria, the IRS court found easily proved the debt met all statutory criteria. It was assessed. It exceeded the inflation-adjusted threshold, which was $64,000 for 2025. A lien was filed, and the collection due process rights had lapsed. Tick off those 4 things. Bingo. Ultimately, the certification was not erroneous because that's the 4 tests you have to see if it's erroneous. If they fail any of those, it would be the IRS met all those requirements. This was not an issue. Now, the court then addressed why all those defenses fell apart. What about identity theft? The court dismissed the identity theft argument because the Internal Revenue Manual exception requires the taxpayer to have actually filed an administrative ID theft claim that the IRS had approved. Dr. Shaban has never filed such a claim. What about refund exhaustion? The court clarified that waiting for a taxpayer to exhaust administrative and judicial refund rights is simply not a prerequisite for certification. Your problems with Congress, they did not allow you to, keep your passport while suing for the refund. Right? And what about the computer argument, right? Well, the doctor's argument about the automated collection computer system will also fail. The court noted the computer merely generates the list. The commissioner, small business self-employed commissioner, will still provide the final review and approval, fully satisfying the statutory delegation rules. Result, tax court upheld the certification, meaning Dr. Shaban's passport is at the mercy of the State Department, which means it's likely to be revoked. Again, our nice little illustration here. We did this tax to travel trap and how it goes, right? This is the mechanics of the 7345 and the Shaman decision. It demonstrates to clients and maybe explains to your staff how quickly a business tax issue can ground their travel plans. First, no shield for embezzlement in this case. Note the graphic on the left part of the graphic. It emphasizes the harsh reality of the trust fund recovery penalty. Even undeniable embezzlement by a family member does not shield a responsible person from the 100% personal liability penalty if they knew or should have known that trust fund taxes weren't being paid. That's the bottom line. And unfortunately, quite often there's a family you might discover embezzlement, right? But then, your brother swore he wouldn't do it anymore. He'd restore the money, and you decide to just trust. And it's like, that's not a good thing. And it's going to immediately make you liable. Again, we don't know for sure the background here of the doctor's case. What was there, right? But still, it's a problem. And once that assessment's out, the court's hands are tied, right? In essence, when we look at that, the quote bubble that's there on the right of this, emphasizes, reinforces jurisdictional trap. Once the debt crossed $64,000 threshold, which was this threshold in 2025, and the lien or levy is issued, the courts can't inquire further into the fairness of the underlying tax. And bottom right, what are our potential resolutions in this structure? The only reliable ways to reverse this are paying the debt fully, obtaining innocent spouse relief, or securing a formal installment agreement or offer in compromise. Those are the ways to clear this. Otherwise, you're there. Now, if you pay and sue for the refund, you will have cleared things up. You paid the debt. You're suing for a refund. If you pay the entire debt, if you're trying to do, segregate out and pay a portion, then yank everything in, that shouldn't work under this statute, because if the liability still being shown as unpaid is above the trigger, then tough luck, your passport is still at risk. And let's go to a second passport case. In this case, this is the case United States versus Richard Hatch. This one comes from the U.S. District Court for the District of Rhode Island, case number 1:22 CV00332, and the opinion was issued on March 2nd, right? This case, is going to be looking at, while that previous case, and we'll look at that one, involved a direct challenge to certification tax court, this case is looking at what happens when a taxpayer tries to force a passport renewal, right, in the middle of a separate active IRS tax collection lawsuit. And he has a valid reason for saying they should give me the passport, because what he's going to try to argue is if I could travel, I could earn the money to pay off the debt. The fact that they've locked up my passport is keeping me from earning the money that I would need to pay off the debt. Okay, let's talk about this, right? So the real question of this case posed was, can a taxpayer use general equitable motions with an ongoing collection suit to force the government to return their passport? And this case is a vital case in jurisdiction. Again, this whole thing about the passports becomes a jurisdictional nightmare, right? There is a rigid procedural boundaries that you and your clients will face. Generally, the courts will not allow you to bypass the specific statutory mechanisms required to challenge a 7345 certification. Right, the court has to have jurisdiction. And the statute is very clear about when jurisdiction will come to the courts. And the problem is, no matter how rational this move might be, no matter how much sense it might make, because the court even admits that, seems to make sense they should do this, but the court can't step in to force the IRS to do it. Okay. In this case, the taxpayer, Richard Hatch, was involved in a long-running tax dispute, and the government had filed a lawsuit against him explicitly to collect on his outstanding tax liabilities, right? Because that unpaid assessed debt over the magic number, the IRS properly certified his account as a seriously delinquent tax debt, which barred him from renewing his passport. Okay. Now, Mr. Hatch filed a motion to compel, asking a district court to use its inherent authority to force the government to facilitate his passport renewal. The taxpayer's logic was a very practical reason, as I noted. He needed his passport to travel overseas so he could make a living, which would in turn allow him to actually pay off his tax debt to the government, right? In essence. The only reason I can't pay it off is they won't let me earn the money because they're holding the passport I need to earn the money. Okay. Well, let's talk about the government's defense and why this is going to fall flat on the taxpayer. The taxpayer is going to lose this case. Is again jurisdiction. The government didn't argue the economic merits of his request. Instead, they immediately said a procedural shield. They argued the court simply lacked the authority to compel renewal in this specific proceeding. The scope of the suits are issue here. The government correctly pointed out that the active lawsuit was strictly for the collection of tax liabilities. Did not deal with the passport issue. And there's a missing legal assertion problem here. Mr. Hatch had made no formal legal assertion under 7345E1. The certification itself was actually erroneous because he didn't challenge the validity of the certification. We're back to that again. Under the proper statute, the collection suit was the entirely wrong vehicle for this motion. And he's probably going to find that, as we talked about in the last case, it's not procedurally incorrect. It's just potentially, there are many things here that could argue for it, but it's not a procedurally incorrect. That debt's there. It's not been satisfied. Bingo. We're there, right? Okay. Now, What's the court's final ruling? Well, the judge agreed entirely with the government's procedural defense and denied the taxpayer's motion. There is no backdoor mechanism. We're back to backdoor mechanisms again. This is a second attempt. Taxpayers cannot use an ongoing collection suit as a backdoor mechanism to bypass the dedicated civil action required by Section 7345E to get rid of this, basically, this hold on your passport. You cannot use general equitable pleas to undo a valid statutory certification. Now, the judge included a footnote acknowledging the economic logic of the taxpayer's request, noting it would seem to be in the government's best interest to let him work overseas to pay off the debt. But the court said they were strictly bound by the statutory jurisdiction, and they simply didn't have the authority to grant the relief he was asking. So what are some of our practical takeaways from this? Well, bottom line, if you represent clients seriously delinquent with tax debt, this is pretty much a roadmap of what's not going to work, right? Procedural discipline. You cannot attempt to bypass 7345 passport challenges into a standard collection defenses or use general equitable pleas to bypass the statute. Again, this, like the Cheyenne case, was an attempt to kind of get around the limited jurisdiction offered in 7345, in this case by simply just not using it. The proper channels, if you're going to litigate the certification, you must use a dedicated civil action, specifically contesting the certification as erroneous. And we already saw how that probably not going to work for him, even if he does it. Okay. And the alternative resolutions is, for the most part, the fastest way to get your passport back is not going to be litigation. It's going to be resolving the underlying debt through statutory recognized exceptions, such as securing an approved installment agreement under 6159 or an offer in compromise. You have to negotiate one of those that will lift the passport restrictions, and that will allow you to go forward. So if you could convince them, the IRS, to give you an installment agreement and you agree on the payment terms, then they could release it, and then that would allow you to earn money, which would fulfill the installment agreement, assuming you convince them to go along with all that. So again, our standard infographic now. And this is the various concepts from both the Shaban and the Hatch cases, right? So it's the mechanic of a 7345 section issue, right? On the left side of this particular infographic, it emphasizes the core triggers. Is there an assessed, legally enforceable tax debt exceeding $50,000, which was adjusted for inflation, was $64,000 back in 2025, coupled with a filed lien or an issued levy? There's also the limitations on judicial review, right? The scales of justice icon, right, on the right reinforces the harsh lesson from civil case law today, or case law date. Courts can only determine if a certification was procedurally erroneous. They cannot grant equitable travel relief or review the underlying assessment. And the staying mobile section, right? This reinforces that setting up an installment agreement or pursuing innocent spouse relief are the most reliable statutory mechanisms to reverse certification and regain the ability to travel. Right. Those are your simplest ways through it. Okay, next we're going to look at Revenue Procedure 2026-16. This involves relief granting a waiver of foreign earned income exclusion time rules in certain cases for certain taxpayers who are in certain locales at the wrong time. This is Revenue Proc 2026-16, issued, as I said, March 4th. It's emergency waivers for the foreign earned income exclusion. And if you have expatriate clients, this is an important annual update specifically designed to protect taxpayers who are forced to flee the dangerous situations abroad and are still looking to qualify for a foreign earned income exclusion on income earned in that country. Now, the core issue in this case, we have Section 911 of the Internal Revenue Code provides a highly valuable tax benefit, excluding from income, earned income up to certain limits, allowing qualified individuals to exclude those foreign earned income amounts and housing costs from their gross income, again, up to specified limits. Now, the issue arises when taxpayers are forced to evacuate their host countries due to war, civil unrest, or similar adverse conditions. And the significance of this is suddenly fleeing a country usually means the taxpayer will fall short of the strict physical presence or residency day count requirements, right? You're thrown out at the wrong time. Without this revenue procedure granting administrative relief, these displaced taxpayers would be doubly penalized by losing their exclusions entirely and having the U.S. tax everything and being stuck with only a potential claim for a basically foreign tax credit on the amounts earned if it was taxed by the other country, which it's likely to be. You earned it there. So let's talk about the baseline requirements under Section 911 for the foreign earning income exclusion. Right. The requirements include the tax home requirement. Taxpayer must establish their tax home is in a foreign country. There are 2 time tests for doing this. Right? They got to pass one of those 2 tests. This is the second key issue. You got to be a bona fide resident of foreign country for an uninterrupted period that includes an entire taxable year. Number 1. Or meet the physical presence test, meaning they're physically present in a foreign country at least 330 days during any period of 12 consecutive months. So obviously, we have the 2 tests. Okay? Now, because these tests are very rigid, and if you're forced to flee a country due to war or whatever, there's a chance you're not going to be able to make these tests work in your case. We're going to essentially offer you a exception, that's a statutory one that we're going to discuss next, right? So what is our statutory exception? The safety net. When emergency evacuation occurs, the exception found in 911D4 is important. This is a safety net allowing individuals to be treated as qualified individuals even if they fall short of the day count test. Now, what triggers this? It's not automatic relief. It requires the Secretary of the Treasury, in consultation with Secretary of State, to officially determine that war, civil unrest, or similar adverse conditions precluded the normal conduct of business. And there is a but-for burden of proof. Most crucial part is, if you think you meet this, the statute places the burden of proof firmly on the taxpayer. They have to establish that but for these adverse conditions and the resulting evacuation, the taxpayer could have been expected to meet the full physical presence or bona fide residence test. In essence, if you're, let's say you go there on assignment, you're there for 2 weeks and war breaks out, so you leave, that's not going to automatically qualify you. Even if you're on the list and you left, you went over there and started trying to establish your tax home before the date in question, right? So you're there and you left after the date in question. You got to show that it was reasonably expected you would have met the test. So it doesn't automatically bring you in. Okay, so let's take a look at the designated evacuation countries for 2025, which is what this tells us, right? These are countries that are affected. So if you're doing a 2025 return and you're trying to claim the foreign income exclusion and your client got forced to evacuate a country, you want to make sure they're in these lists and that your client left, established their presence before the departure date, left after it. So, first country, Haiti. That goes the entire year of 2025, all the way back to January 1st. That's also true of Ukraine. The Democratic Republic of the Congo, that departure date is January 28th. Doesn't start until then. South Sudan's departure date does not start until March 7th. Iraq's departure date does not start until June 11th. Lebanon's departure date does not start until June 22nd. And Mali's departure date does not start until October 30th, right? So, as we say, to qualify, you must depart the country on or after the date listed. So you were there before the date, you leave after the date. If you left prior to the date because you thought war might be coming, but you left before everything actually broke out, for this effective date that the government is saying is the date we would allow you to leave on or after that date and be deemed to qualify if you can establish you would have qualified, then you're not going to be covered if you don't meet those requirements. Now, there are strict timing requirements for relief. Let's start with number 1, the on or before trap. The IRS places a very strict timing prerequisite on this relief. To be eligible, the taxpayer must have already established residency or been physically present in a foreign country on or before the official departure date. So keep that in mind. Okay? The IRS gives an example based on Haiti. Okay? The cutoff date for Haiti is January 1st, 2025. If the taxpayer arrived in Haiti and established their presence on January 2nd of 2025, they're completely ineligible for this relief because they arrived after the problem was already there and it's been certified. Right? That's the deal. So don't assume an evacuated client automatically qualifies. Review their passport stamps and travel itineraries against the revenue procedure deadlines. If they do qualify and have already filed, you may need to prepare amended returns to claim the exclusion in this case. So, infographic time again as we go down because we love infographics. And we're going to look at this case at U.S. taxes abroad, the 2025 exclusions and emergency waivers. So again, the standard rules, the left side of this graphic illustrates the baseline establishing foreign tax home and passing either the bona fide resident test or the strict 330-day physical presence test, as mentioned there. Right? The waiver mechanics, the right side visually breaks down the emergency waiver process we just discussed. It clearly highlights the reasonable expectation rule. Remember, you have a burden to show there was reasonable expectation you would have met the test, but for the problem, whatever, on that issue. And you've got to show, reasonable expectation and the prior residency required rules. So you start establishing a residency before that date and you left after that date, right there. And the bottom right contains a quick reference table of the primary 2025 emergency waiver countries, right, and their effective dates. Now let's talk about reporting information returns digitally. An IRS not only is going to have a category that just automatically forms 1099-DA if the proposed regulations are enacted, would simply allow somebody like Coinbase to say, either you accept being electronically given your 1099-DA for your digital currency sales, or we're not going to let you trade on our platform. Right? You're no longer a customer unless you agree to that. So that's what we're looking at here. So these are proposed regulations, Regulation 105-064-25, and accompanying notice 2026-4, which were both issued on March the 6th. Right? So the sheer volume of high-frequency cryptocurrency trades makes traditional paper reporting basically unmanageable. If you got a client that's really into crypto trading, you may get boxes if you request paper 1099s. So that's kind of the issue that we're running into here, right? So that'd be pages of 1099-DA information. So the IRS looks to eliminate the paper default and allow brokers, for digital assets at least, to simply say, we're not issuing paper under any circumstances. Tough luck. Okay. So the core issue is, like we know, reporting for digital assets under Section 6045 brought entirely new challenges, specifically due to, if you got somebody who's active in this area, they've got a staggeringly huge number. This is like a trader's level of numbers that we're seeing, right? These proposed regulations are designed to dramatically reshape the consent rules for electronic delivery of digital asset tax statements, essentially allowing the broker to simply say, my way or the highway, you're going to accept digital statements from us or you're not going to work with us, which they're not currently allowed to do, but these regs would change it. So what these regs address is what the IRS called the unmanageable burden that traditional paper reporting rules place on brokers handling high-frequency crypto trades. And what it does, though, is set the stage to eliminate the paper default there and potentially for other types of assets as well. That's what the notice is asking for comments on. So why is the IRS updating these rules? And they explain that in the preamble to the proposed regs. The IRS says it's a sheer practical necessity. Digital asset transactions are almost exclusively conducted online via computers and mobile apps. Under the existing rule, there's a bottleneck here. If the customer fails to affirmatively consent to electronic delivery, the broker is legally forced to issue paper statements, which can be boxes of statements, right? And that's the paper burden, because digital asset investors often engage in hundreds or even thousands of trades annually. Making these statements, mailing these statements would force brokers to print and mail thousands of pages per customer. And this is a massive, unnecessarily burdensome compliance cost that the IRS seeks to minimize by these proposed regs. So, what are the key departures from what we have currently? First, there is called the streamlined process. Proposed regulations basically introduce major departures from existing Section 6051 rules to streamline the consent process. First, no paper alternative. First and most importantly, digital asset brokers are no longer required to offer their customers a paper 1099 DA option. Like I said, do it electronic or get out of here. You're allowed to do that. Because as noted, they're allowed to terminate any client that won't consent to that. So if a client refuses electronic delivery, the broker is now explicitly permitted to terminate the business relationship or limit services, provided they disclose this upfront to the client that this is a requirement. And additionally, brokers do not have to allow clients to withdraw a previously given consent. The IRS has also eliminated the requirement for clients to technically demonstrate the ability to access the electronic statement. Reasoning if they can trade crypto on an app, they possess the required technical capability to be able to handle a PDF. And I'm sure some of you are thinking they haven't met my clients. That's possible, right? They can accomplish one thing on their phone does not mean they can accomplish something else. But IRS is saying we're not going to take that excuse. That'll be the background. What are the delivery methods and retention requirements under the proposed regs? Now, the qualified methods, the broker must utilize a qualified electronic delivery method, which generally means directly transmitting the form as a secure email attachment or posting it to a secure website or app portal. Right? There are secondary alert issues. If a broker chooses to post a statement to a portal, they're required to send an email notice and offer the customer the option to request secondary alerts, such as text messages or push notifications. There is a 7-year rule in place here now. Strict retention requirements for brokers must maintain these 1099 DA statements and make them available to customers upon request for at least 7 years. And the effectivity of these regs? These are regs required to be furnished on or after January 1st calendar year immediately following the final regulations adoption. So if they're adopted in 26, this would apply for 27. Also issued the same day was notice 2026-4. Now remember, the proposed regs are only going to give relief to Form 1099 DA filers. But this notice was issued alongside those regulations, specifically to request practitioner feedback on expanding this framework. And what we're talking about here is they're looking at a traditional securities exception. Now, the IRS is well aware traditional security brokers face similar burdens. It is considering extending these paperless default rules to traditional 1099-Bs. That means your clients would only have access to an electronic version of their 1099-B. The broker would not have to allow them to say, send it to me in paper. You could say that, but the broker can fire you. That's basically how it's going to work, right? That could be a problem for some clients because some clients, do not have the capability, and they're still bringing me paper statements, even though they deal with brokers where I know I could get everything electronic. And especially a broker like Edward Jones, where if they got a lot of stock sales, I know Edward Jones has a way to, on their electronic access, to be able to have them send me an Excel sheet with all the 1099-B information in a flat file that I can easily import into my tax software. But there are way too many clients who don't understand how to do that, and I have problems with that. So that's the issue. But the notice does reflect the need to protect the vulnerable. So the IRS is asking for comments on how to protect non-tech savvy taxpayers, the elderly, or those with disability if traditional paper defaults are limited across the board. And I was just talking with somebody today whose sister who, by the way, this is a sister born in the mid 1970s. So not a boomer, but who just absolutely doesn't want anything going over the internet, right? Doesn't want to have anything there, thinks if anything goes there, her identity will be stolen and everything will be taken from her. Yeah, I'm not saying she's not tech savvy. Maybe she's not the elderly or those with additional disabilities, but if paper defaults are eliminated, she's going to have a problem. I'm just saying, she's going to have a problem. And her sister kind of recognized, yeah, she's going to have a problem. Long story, they're still trying to get some stuff straightened out, from their father's estate. And it's like, yeah, and sister doesn't want to communicate anything electronically, which is complicating matters. Her sister, who was born in 1965, so makes her a late boom, maybe a very, very late boomer, or an early, what was that, Gen X? Yeah, group. Yeah, she doesn't have any problem doing electronically, but her sister has problems, right? So again, as CPAs and EAs, we're going to have to start advising our clients that they're going to need to embrace that the reality is coming. You're going to have to embrace electronic tax documents. But you might also want to submit comments to the IRS regarding this notice, because you probably have clients like this person's sister who are going to be a real problem if everything's got to be done electronically. And, and some of them, there are some who just can't deal with it. There are some who just, are going to not accept it. We need to understand, why people might reasonably not want to get electronic statements, or even unreasonably. And also remind them unreasonable people vote. So bingo. That's just part of the game. Unreasonable people vote. They have a right to vote, right? We don't exclude them from society because they're totally unreasonable about these things. So we have to do that. But you might want to do that because getting feedback now is going to be important. Indicative. The IRS is going to say, if they don't get feedback, they're going to say, well, nobody objected to this, so it's fine. We asked for guidance, got none. So hey, everybody's okay with doing this. So if you have problems with this, I realize it's a bad time to ask for guidance, or to ask for comments, but you might want to consider those comments. Could save you a lot of work. So finally, our last infographic, the shift to paperless, the new IRS rules for digital asset reporting, right? So the left side of this graphic shows us the new paperless DA rules, right? It highlights the aggressive new posture for digital asset brokers, no paper alternatives required, the explicit right to terminate non-consenting users, and the enhanced 7-year retention requirements for those electronic documents by the broker, right? So those are all what's going. And by the way, these coming out as proposed regulations tell you it is highly likely that the IRS will adopt these, okay? Now, the potential future expansion, right? This is highlighted on the right side. Remember, this will now affect all of your clients who have any sort of brokerage account, not just crypto specialists. The IRS is pointing to a 95% adoption rate of the internet, right? The IRS is seriously considering applying these identical paperless rules to traditional security accounts and Form 1099-B composite statements. Now, the deadline for comments is May 5th. So you have a little bit of time after tax season closes. Get past April 15th, but not a whole lot. If you have strong feelings on this, I very, very much suggest you write the IRS and specifically indicate your objections in this area. Would also suspect that a number of organizations, CPA societies, EA associations, I suspect the ABA may have some comments on this too, are going to be putting comments in on this. And so you might want to reach out to the organization. Remember the AICPA? I'm pretty sure this is something the tax section will consider comments on. So you might reach out and let people like, those on staff at the AICPA who work with like the tax executive committee and whichever, in this case, I think it would be a task force, probably the individual task force, that handles recommendations area, about why you think action is necessary and comments are necessary here. And you'd like to have them come from the national organization, right? Along with any ones you'll throw in, right? But you might ask about that. So this is the end of our update for the week of March the 9th of 2026. Today we looked at the personal liability traps in estate tax collection, retroactive entity classification problems, the 2026 auto depreciation limits, passport revocations and how limited your options are once you're at the point of the IRS certifying, that you have a seriously delinquent tax debt, and what the IRS sees as a future of digital and even non-digital asset reporting, right? So information reporting forms could end up being all electronic. Basically, if you have any questions, my email address is on the slide, Ed Zollars at currentfilltaxdevelopments.com. If you got the copy of the slides, which, by the way, every week we do post a video. It is posted on our website, right? It's also available. I will upload it to YouTube if you want to look for it there. You can get it there. But my email address is edzollars at currentfilltaxdevelopments.com. And I also monitor posts on the Connect site for the Arizona, New Jersey, Idaho, Minnesota, Illinois, and Washington Society of CPAs. So if you have any questions you pose there, I may jump in and answer them. But otherwise, I want to thank you for your time and attention today. And as I say, during tax season, it's always possible I'm going to hit a week where I just don't have time, and I end up having to skip a week. Hasn't happened so far, and I think I got better processes this year to make it less likely I'll have to skip it. But do remember that next week is the absolute March 16th will be the absolute drop dead date to make sure all your extensions went in for your pass-throughs. So I have anybody fighting me on that and wants to try to get their stuff out before that date, and then suddenly we have to go and extend it anyway. Yeah, I could have some issues with that date. We'll just have to see. But I'm hoping not to. I'm hoping that this year the procedures are making it easier for me to go through and do this. But otherwise, we will hopefully therefore see you next week with more current federal tax developments.